Rising interest rates have the U.S. on a slippery slope. We are headed towards surging debt payments larger than the entire defense budget.
Well, the hikes mean increased credit card and mortgage rates for consumers and also soaring interest payments for the federal government itself. Abigail Robertson explains.
As the Federal Reserve fights its war on inflation with repeated, unusually high interest rate hikes, it's not just the American people paying more to borrow money, but the federal government, too. In fact, federal interest payments are on track to cost more than the defense budget.
Everyone knows you can't run up your credit card forever. At some point, you have to pay those bills back.
Economist Stephen Moore is among those sounding the alarm on Washington's reckless spending.
If we don't get the spending under control, we're going to be looking at higher interest rates. That's going to hurt our housing market because mortgage rates will go up. It's going to hurt consumer finances and small businesses as they try to borrow. We've got to get out of this cycle of spend, print money, and then raise interest rates, or else we're going to be facing a very precarious future.
The federal government is already $31 trillion in debt, and that figure keeps going up. The rising costs of financing that debt will leave less and less money for Congress to spend on things like defense, health, infrastructure, and education.
One of the reasons that these interest rates are going up so rapidly now is because we let inflation get out of control through this massive government spending. So we have to start. Job number one is to bring down government spending, to bring down inflation, and to restore fiscal sanity in Washington.
According to the U.S. Treasury Department, in fiscal 2022, the federal government made $475 billion in net interest payments, up from $352 billion the prior year.
The higher interest rates do slow the economy.
Dr. Stephen Skanke, an economic advisor at Keel Point Investments, tells CBN News' Faith Nation the Fed needs time to see the cumulative effects of its rate hikes.
As they slow down the rate of increase to 0.5%, as John said, and probably at the end of January or on February 1, maybe 0.25%, they're giving us time to see those changes actually start to take place.
President Biden claims his budget and economic plans are working.
$1.7 trillion we've lowered the federal debt. No administration has ever cut the deficit that much. Now inflation is coming down as well.
But media fact checkers and economists point out that Biden's spending bills have actually made the deficit bigger than it would have been otherwise. In the months ahead, the economic focus is likely to shift from rising prices to rising interest rates and their impact on the economy and federal spending. In the longer term, those rising interest rates are going to be very expensive, both for consumers and Washington. Abigail Robertson, CBN News.
All right, Abigail, thanks so much. CBN News financial editor Drew Parkhill is here now to help make sense of all this. Drew, what happens if interest rates keep going up and Washington keeps spending more money, more of our money?
Well, I can tell you, Andrew, interest rates are going to keep going up. Everybody always blames the Fed, but I want to show you a graphic because interest rates have a life cycle of their own. In 1940, at the end of the Depression, interest rates were 0%. Roughly, basically, short-term rates. By 1980, they had climbed up to the 18 to 20% range and longer rates. By 2020, 40 years later, they're back down to 0%. So guess what? They're not going to stay at 0%. They're going to keep going up. Now, how's that going to affect the federal deficit? Well, you're going to be paying more money on your mortgages. You're going to be paying more money in your car loans. They're going to be paying more money in Washington on federal deficits. Now, you can see the impact that they're going to have. We have another graphic here that shows that if interest rates go up just 2% above the forecast from the Congressional Budget Office, that's going to add over 10 years up to $4.2 trillion of debt, and it'll probably add more. So that means more spending and more debt is coming.
Well, can anything be done to prevent a possible crisis? If the Biden administration says, Drew Parkhill, come in, help us out here, what are you going to recommend to them?
There's really only about three outcomes here, Andrew. Number one, they can either cut spending in Washington. Do you think that's going to happen? Don't hold your breath. Number two, they could raise taxes. Well, that's not politically popular. It's very possible that's going to happen, but politicians don't like to do that. The other outcome is higher inflation. Inflation goes up. That makes it easier to pay off the debt. Now, this isn't going to happen next week or next year, but a decade or two down the road, this is going to happen, and we're going to see real problems in Washington.
All right, so you're talking about what the government can do, Drew, but what about you? What about me? What can individuals do in this economic climate?
Always keep an eye on your own financial situation, Andrew. You know, buy things at the right price when you can, but pay attention to who you vote for. And if they say they're going to keep an eye on spending in Washington, hold them accountable. Make sure they do, because that's where this crisis is coming from.
All right, Drew, appreciate your insight. Thanks for being with us today.